What 7 charts and headlines are making the case for gold this week? Let's find out. The gold price does not exist in a vacuum, nor does it respond only to FOMC announcements. Where the gold price is today is often months, if not years, in the making. We need to look out for patterns, anomalies, and headlines that will perhaps act as the proverbial canary in the coal mines, giving us the warning signals that all is not well in the economy, reminding us that gold will continue to be in demand in the coming months and years. Here I give you the 7 charts and headlines that caught my attention this week and tell me that despite a quiet week for both gold and silver, they are still set to be the last one standing in what is rapidly becoming a pretty toxic coal mine. First up, phantom debt. Phantom debt is a term coined by Wells Fargo senior economist Tim Quinlan. It's a reference to the debt accumulated by consumers who are using buy now, pay later platforms. This article refers to the $700 billion hole in economic data. And why is it a hole? Because this data goes unreported. That's right. In the US, there is no reporting mechanism for these buy now, pay later platforms to report this information. Currently, 1 in 5 consumers use these services to buy everyday goods, and this is set to grow. Juniper Research estimates that in 2024 alone, BNPL transactions will total $334 billion, ballooning to $687 billion by 2028, a growth of 105%. And to be clear, 20% of the US economy right now cannot afford to live. That's today, not in 2028. That's just taking into account those who spend online. And you've still got the unbanked to consider as well. Now, of course, we're all by now familiar with the narrative that the US economy has sailed through post-pandemic, thanks to consumer spending. And consumer spending is obviously vital to any economy. In the US, it contributes to around 2/3 of GDP. But this BNPL data shows that, surprise, surprise, all is not well. Information like this really should set off alarm bells. The people that tell us how well the US economy is doing, i.e. the Fed and Wall Street, are looking at the conventional metrics that assess consumer credit. And these metrics suggest that the financial well-being of US households, on the whole, appears to be in a robust state. But these metrics are missing this huge piece of the picture, and therefore the data that guides policymakers is not worth much at all. And what of the consumer debt that is recorded? This takes me to the second item that grabbed my attention this week, thanks to Zero Hedge. Take a look at this tweet. This chart shows US consumer credit card debt at a record high against personal savings rates, which are at a record low. With inflation remaining stubbornly high and interest rates staying put, we fully expect the gap between these two lines to keep growing. And to be fair, why shouldn't they? After all, it's pretty similar to how the US government is managing their own spending. Am I right? The ratio of credit card debt to personal savings is at its highest in a decade. More than 1/3 of American adults, 36%, have more credit card debt than emergency savings. Last year, credit card debt soared past $1 trillion. Now, many will reassure you that this is okay because wage growth remains robust and the stock market has performed well. But performance comes from confidence that all is well in the foundations, and data such as this shows that the foundations are not strong at all. Instead, they are an illusion that make it seem as though the consumers are feeling confident and spending like this because they can afford to. But credit debt and no savings in a high interest rate environment shows that they can't, and pretty soon that will come back to bite every aspect of the narrative that the US is thriving. And what of the banking system? Here's the third item that caught my eye. There are more than 4,000 regional banks in the US, and there is $1.9 trillion of real estate loans outstanding in the US economy. Who are the lenders of choice for this industry? The regional banks. And with rising interest rates, growing consumer debt, and stubborn inflation, Barry Sternlicht, the CEO of the $115 billion real estate giant Starwood Capital Group, is worried. He refers to the real estate market as a fragile animal and believes that pretty soon the cracks are set to show. And once they show, they'll just get bigger, and the domino effect will play out. It's little wonder that people are predicting the Greater Recession is just around the corner. And speaking of recessions, what fun it must be to print your way out of one and not think about the consequences. This is what item 4, courtesy of the Financial Times, made me think about. Former Bank of England Governor Mervyn King, who seems to have had a kind of road to Damascus conversion since leaving Threadneedle Street, has criticised central bankers for forgetting what the impact of money printing might have been on an economy. Speaking in a debate in his new home, the House of Lords, Sir Mervyn said that the academic economics profession has essentially jettisoned the idea that one might ask what the growth of broad money was telling us, and he added that this consensus had led to the problems that we are now too familiar with. It all feels a little bit too much too late. This is, after all, the man who pushed the button on QE. You might think on his handover notes or when interviewing for his replacement, he might check to see if everyone is aware of how money printing plays out. And you can call it collective amnesia if you like, but I would call it selective amnesia. I would posit that everyone is aware of the consequences of money printing. However, central bankers and the governments around them seem to live in a false sense of security that they can control everything and will know when to stop and how to manage the after party. But as we all know, they don't. And that is why we are now seeing rampant demand for physical gold because of these consequences. Cue my 5th and 6th headlines for this week. Yep, gold demand in Asia. China and Korea, in these cases, is on the climb. Whether it's buying affordable gold beans in China or gold from a vending machine in Korea, the point is that gold dealers are making the precious metal accessible to all income levels, to a wider selection of buyers. And they only do this because there is a demand there. The demand is there despite the record prices. And why is there a demand there? Yeah, because the consumer is apparently more apt at seeing the cracks in the economy than perhaps the central bankers and the Wall Street traders. And finally, did you ever hear the one about gold and silver being timeless, about we have sought them out for hundreds of years, about how they hold their value, how they're tangible, about how they can't be destroyed? Well, here's a story about some treasure hunters who found $43 million worth of silver at the bottom of the ocean. On November 23rd, 1942, a ship was sunk by Japanese tornadoes in the Indian Ocean. As well as 900 people on board, it was also carrying 2,364 bars of silver that had been purchased by what was then known as the Union of South Africa, and they were set to be turned into coins. Fast forward to 2017, when a specialist salvage vehicle from Argentum Exploration Limited recovered the bars, and the proceeds of the haul and where they go have been the subject of a court case this week in the UK Supreme Court. The story is well worth reading, and if anything, it serves to remind us that gold and silver really are timeless. They continue to be in demand decades on, hundreds of years on, despite sitting at the bottom of the ocean for 80 years. I don't foresee anyone saying that about paper money in 80 years' time. So that's it. A super quick roundup of items that have grabbed our attention this week. If you're wondering what's next for gold or silver, then check out this video for more info.